Did you know that the Canada Mortgage and Housing Corporation, CMHC, processes mortgage insurance applications in mere seconds with their online system? This efficiency can save both time and money for homeowners and investors alike. Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. Today, we're diving into the world of CMHC's homeowner and multi-unit mortgage loan insurance products. As Canada's first mortgage loan insurance provider, CMHC has over 70 years of experience, offering a broad range of products designed to meet the needs of Canadians coast to coast. Whether you're a self-employed individual, a first-time homebuyer, or an investor looking at multi-unit properties, CMHC has tailored solutions for you. One of the standout features of CMHC is their unique position as the only provider of mortgage loan insurance for multi-unit residential properties in Canada. This gives them a distinct advantage, as they offer valuable insights into the rental market that can support your business objectives. Their products not only support the construction and purchase of multi-unit rental properties, but also assist in refinancing, providing a comprehensive approach to multifamily real estate investment. CMHC's commitment to providing industry-leading products and services is backed by their deep understanding of the Canadian market. With tools like the Default Management Tool Selector and the GDS/TDS formula, they equip investors with the necessary resources to make informed decisions. Their mortgage calculator can help you compare rates, payment frequency, and amortization to find the best mortgage options available. Beyond mortgage loan insurance, CMHC offers a 360-degree view of the housing industry, providing data, research, and insights that empower you to make sound business decisions. Their holistic understanding of the market is invaluable for anyone looking to navigate the complexities of Canadian real estate. For those involved in the multifamily sector, CMHC's products and insights are crucial. They stand as a beacon in the industry, offering decades of expertise and a commitment to keeping you one step ahead. In a world where inflation and currency uncertainty pose challenges, having a reliable partner like CMHC can make all the difference. In 2025, Canadian investors are at a crossroads, faced with the decision of whether to allocate their capital to gold or real estate as a store of value. With inflationary pressures and currency uncertainty looming, both assets present unique opportunities and challenges. This analysis, originally reported by Victor Hale, delves into the performance of gold and Canadian real estate, their correlations with inflation, and their roles in portfolio rebalancing strategies. Gold has shown a remarkable surge, reaching $3,539.83 per ounce as of September 3, 2025, marking a 41.83% increase year over year. This rally is driven by several factors, including Federal Reserve rate cuts, heightened geopolitical tensions, and concerns over currency debasement. The weakening of the U.S. dollar has bolstered gold's appeal as a safe haven asset. Analysts project that gold might reach $3,700 by the end of the year and possibly $4,000 by mid-2026, reinforcing its reputation as a timeless hedge against volatility. On the other hand, the Canadian real estate market presents a more complex picture. While national home sales have risen by 11.2% since March 2025, regional disparities persist. The Greater Toronto Area has seen gains, but areas like Ontario and British Columbia have experienced price declines attributed to U.S. trade tensions and reduced buyer confidence. Despite these challenges, real estate remains appealing as an inflation hedge due to its ability to generate rental income and adjust to rising costs through index-linked leases. Real estate's resilience is further demonstrated through its historical performance, where property values have outpaced inflation by 3.4% annually. However, challenges such as price declines, supply constraints, and interest rate sensitivity continue to pose risks. The Canadian Real Estate Association and the Canada Mortgage and Housing Corporation forecast a 1.7 to 2% drop in national home prices in 2025. Nevertheless, The Bank of Canada's projected rate cuts could stabilize prices, offering a silver lining for investors. When considering portfolio rebalancing strategies, a balanced approach is essential to harness the strengths of both gold and real estate. Analysts recommend a 5 to 10% allocation to gold through exchange-traded funds for volatility reduction, while real estate can occupy 20 to 30% of a portfolio for income and capital preservation. Hybrid approaches that combine gold's liquidity with real estate's income potential are particularly favored, especially with multifamily properties in focus for 2025. Ultimately, both gold and Canadian real estate offer distinct advantages in 2025. Gold excels as a hedge against currency devaluation and geopolitical risks, while real estate provides income and localized value preservation. Investors are encouraged to adopt a balanced, flexible strategy, leveraging gold for stability and real estate for income. By integrating both into a diversified portfolio, investors can navigate the year's uncertainties with resilience and foresight. As we wrap up today's episode, let's take a look at some promising developments in the urban commercial real estate sector, as reported by Ranks.ca. Allied Properties. Real Estate Investment Trust's CEO, Cecilia Williams, recently expressed optimism about the improving fundamentals in urban commercial real estate, or CRE. Despite a net loss of $94.7 million in the second quarter, Allied Properties is seeing increased leasing activity and a stabilization of net rents, which are positive signs for the future. Allied Properties, headquartered in Toronto, conducted 317 lease tours in its rental portfolio during the quarter, marking a 13% increase from the prior quarter. This uptick in activity is a testament to the growing demand for urban workspaces, as Canadian cities are increasingly becoming centers of creativity and innovation. Industries represented by touring organizations include technology, media, professional services, education, and medical uses, indicating a diverse interest in urban spaces. The Trust's strategic positioning is further supported by its recent agreement to acquire Westbank's share in the M4 building in Vancouver, which it co-owns. This acquisition is expected to close by the end of September and will bolster Allied's urban portfolio, adding significant office, industrial, and retail space. In terms of leasing activity, Allied renewed 54% of the leases maturing in the quarter, with an increase in rent levels on these renewals. The average in-place net rent per occupied square foot rose to $25.32, showcasing the company's ability to maintain a competitive edge in the market. Looking ahead, Allied Properties plans to continue selling non-core properties to streamline its portfolio and improve liquidity. The company has already put several properties under sale contract, with expectations to close these deals by year-end. This strategy is aimed at reducing debt and maintaining ample liquidity, positioning Allied to address upcoming debt maturities with minimal impact on interest expenses. Overall, the outlook for urban commercial real estate in Canada appears optimistic, with Allied Properties leading the way in adapting to changing market dynamics. By focusing on strategic acquisitions and maintaining robust leasing activities, Allied is well positioned to capitalize on the growing demand for urban spaces. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.